Looking at the SEPs, we have now basically 4 years of inflation above target, and policy never gets to the long run rate. I'm wondering if you could address that from two perspectives. One, within the new framework that the Fed adopted last year, and second, from the perspective of the average household that's now being asked to pay higher prices and increasingly higher prices for 4 years running, when for some this year, real wages have actually gone down.
Sure. So, as you can see, the inflation forecasts have moved up a bit in the out years. And that's really, I think, a reflection of, and they've moved up significantly for this year. And that's, I think, a reflection of the fact that the bottlenecks and shortages that we're seeing in the economy have really not begun to abate in a meaningful way yet. So those seem to be going to be with us at least for a few more months and perhaps into next year. So that suggests that inflation is going to be higher this year, and a number, I guess, the inflation rates for next year and 2023 were also marked up, but just by a couple of tenths. Those are very modest overshoots. You're looking at 2.2 and 2.1. 2 years and 3 years out. These are very, very. I don't think that households are going to notice a couple of tenths of an overshoot. That just happens to be people's forecasts. We want to foster a strong labor market, and we want to foster inflation averaging 2% over time. And I think we're very much on track to achieve those things. In terms of the framework, I see this as very consistent with the framework. We want inflation expectations to be anchored at around 2%. That's really the ultimate test of whether we're getting this done under the framework. And we do want inflation to run moderately above 2%. I wouldn't put too much on a couple of tenths over 2% in 2023 and 24, one tenth in 24. But you're right; those are the numbers.